Hey, Rent to Retires, it's Adam Schroeder here for another episode. Once again, joined by the founder and CEO of Rent to Retirement, Zach Lemaster. And we are joined today by Adam Kintigh. He is an executive corporate analyst with one of our partner companies, NCH. And we're going to talk taxes today, but not the way we usually talk taxes. We're going to talk about the importance of actually using a real estate CPA, someone who really knows what they're doing, as opposed to just, hey, I Googled CPA Austin, Texas, and found somebody willing to do it. So, Adam, thanks for joining us.
Thanks for having me.
Absolutely. So tell us a little bit when it comes to just in general taxes versus real estate taxes. What about real estate makes it complicated for people?
Yeah, so a lot of people, when we're filing for real estate, the deductions don't work the same as they do when you're just a W-2 employee. A lot of people have a W-2 job. They take out the taxes as we make money. At the end of the year, we hope we get a refund. When you own real estate, there's all these expenses that come in, and it's not how we would think. Of course, the IRS makes it very complicated, where if you're doing a repair or maintenance, that is treated a certain way versus if you're putting on a new roof or new flooring or remodeling the kitchen. So we really have to have a CPA that understands and knows how all these different expenses fit into your tax return. And that's one of the biggest challenges today, is having a CPA that is competent and knowledgeable, especially across multiple states. When we're building out a rental portfolio from Ohio, Florida, Texas, all these different states that we're owning property, and they all have different rules. So that's the most important thing, is having a CPA that understands those different states.
We know that real estate has many tax advantages. I mean, that's one of my favorite parts about investing in real estate altogether. I mean, above any other asset class, like there's nothing that comes close. But most people are unfamiliar with, how to actually file the taxes, right? There's two things, and that's so fundamentally important, especially when you're investing across multiple states. And we've talked about kind of these two different professionals to be aware of, right? You have your tax strategist, which is someone can kind of help you on like the path forward and how to structure your investing plan to take advantage of the tax strategies you're trying to employ. And then there's a CPA that's actually filing your taxes. Now at NCH, you guys do both, which is great. But really what we want to hone in today is like the actual filing of the taxes aspect, because we get asked all the time, like, hey, do you have a CPA recommendation? I'm buying in multiple different states. And well, the short answer is, yeah, we do. But we also want to ask, okay, how are you currently doing your taxes? And so many people are filing their own taxes, or they have a CPA that they've just developed a relationship with, which is done right by them and is great at the level they used to be at. But now that they're investing, especially in multiple different states, it's important to have a CPA that understands real estate, understands filing in any state that you invest in, and how to really appropriately structure those tax returns. And I think that a lot of it is sometimes some cleanup, right? So it's much better to have a CPA from that first year and have those discussions early on versus try to go retroactive and to previous years and clean up a mess. But I guess what I'm getting to, Adam, is that, I mean, let's talk a little bit about like filing out of state. That's a question we get all the time of, okay, like, well, do I need to file taxes in this state now that I have real estate there? The answer is probably yes, depending on the state. But like, what are some key points and fundamental reasons why you need a CPA that knows how to file in all different states and understands the real estate benefits of tax, or the tax benefits of real estate investing?
Yeah, the penalties are severe. And one of the things we look at today, especially, is they've hired all of these 87,000 IRS agents. And the things that they most commonly look at is people that are filing Schedule C and Schedule E, where they're itemizing all the expenses. So, for example, if you are a person living in California, most of the time your CPA understands that you have property in Florida or Texas. And though those states do not have state tax returns, a state like Florida, you still have income tax if you have rental property. It's between 5.5% and 6.5%. That has to be reported. So if you're renting out bicycles in Florida, you got to pay tax on it. So different states have nuances, but the fact that you live in California, they use a specific example on the California Franchise Tax Board website. Said, I have a property in Nevada. I have a Nevada LLC. I have a property manager in Nevada. Do I have to register with California and pay my $800 franchise tax? Answer, yes.
Big
Because
shot.
you are because you're thinking about a business that is outside the state of California, but you are residing in California while making those business decisions. We want our $800. So little things like that. And when do they actually catch you, or when does it catch up to you? It's not the first year. They usually wait 3 or 4 years. Then they notify you that there was a mistake or an error after we've gone past that time where we could go back and do amendments. So normally if I can do amendments within a 3-year period to take deductions or other things. If not, none of my deductions are allowed, and I end up in a terrible position owing a lot of money in taxes and in battles with the IRS.
So are you saying, like, if somebody has properties, even in non-tax states, like what about like somebody who lives in a no income tax state, let's say like I live in Texas and I'm investing in a state like Florida where they don't have income tax, does somebody like that need to worry about it?
Absolutely. You're living in Texas, so federal is federal. And though Texas does not have a state income tax, the states that you own property in, if they have a state income tax, you'll have to pay that tax. So even though you're not paying it in Texas, you are paying it appropriately in the state that you're making money. So that's the importance of making sure that you have that competent CPA, because failure to file or missing it is not an excuse. They would expect you to figure that out. And a lot of people are using TurboTax and plugging their own numbers in. And again, this is why the Schedule C and Schedule E's are at the top of the audit list, is because a lot of people are doing their own taxes and they're making those mistakes.
Same thing with like depreciation, right? Like the IRS treats depreciation as if you're taking it, and you're taxed appropriately on it, on the reconciliation when you sell it, even if you're not taking it. So, I mean, it's just important to, I mean, the short answer is you just need a CPA that understands real estate across the country in multiple states. And if you do have the right person, like a good CPA is going to pay for themselves tenfold, right? I mean, and just avoid the headache and the potential penalties. Real estate and running a business in real estate, I mean, combine those two things. That's what is super sexy about investing in real estate. And from a tax side, about as sexy as taxes can get, I guess. But strategically speaking, I mean, that's really how people can scale their portfolio and use the tax advantages of both running a business and a real estate portfolio and owning real estate collectively. And that's why it's important. I think, obviously, you guys are a top recommendation for LLC structuring and forming businesses. You formed my business many years ago, and have formed multiple businesses for me since. But I also enjoy the tax aspect. Like, it goes hand in hand with that you also have the tax professionals in the CPA team that can actually file the taxes on the back end. I know Adam used you to file his taxes this last year as well, and help to make sure he's doing everything on the up and up. So it's a good thing to have the right professionals that understand real estate, understand your specific plan on a business and real estate side, and that they're all on the same page, right? Because sometimes you can have an attorney, a CPA, and a tax strategist, and everyone like in different lanes and not be communicating on the same page, and sometimes give you misinformation. I think it's important to have a collective team that understands what you're trying to do. Adam, I know that you had some top like 5 misconceptions or mistakes that people make when they're filing their own taxes, which again, when you start investing in real estate, just hire the right CPA. They're going to give you, it's an education piece too, right? I mean, the education that you're going to get from working with that CPA is going to allow you to tailor your strategy in the future significantly. So just stop doing the TurboTax thing, please. Because we've all heard about those horror stories where you do something wrong for a significant amount of time, and it really can be rather detrimental. But let's go through those 5 things that you've mentioned, the 5 top mistakes that you see.
Yeah. So you hit on the first one, was not depreciating the property. And some people look at it and say, well, I'm not required to depreciate the property, so therefore I'm not going to, because when I sell it, we have depreciation recapture. And whether you took the depreciation or not, when you sell the property, the IRS is going to act as though you did, and you're still going to have depreciation recapture. So I can see virtually no reason that you should not be depreciating the properties and taking advantage of those tax breaks we get now, because you are going to pay it later on, even if you didn't take the depreciation. So That was my number one on the
So
list.
not depreciating the property altogether, or probably even just doing depreciation inaccurately, right?
Correct.
And just a side note, I mean, when you're running a real estate business and you have a CPA file your taxes, that is a business expense that can be deducted, right?
Absolutely.
There you go.
Yep. Now the second
making
thing,
sure you're doing his taxes right.
that's it. So we were talking about the why it's important to have a CPA that understands different states, and I use California as one example. Another great example is Tennessee. When people are buying properties in Tennessee, if you are a business that owns property in Tennessee, you have a franchise and excise tax, 6.5%. However, if you are a family-owned business, so I had a guy that he had, it was him, his brother, sister, cousin, uncle, a group of people that were owning a piece of property. They qualify for what's called a FONCE exemption, FONCE. It's an exemption from that tax, but it's a form that has to be filed. You need a competent CPA that can make sure that that's done. It has to be filed every year. But by doing that, we waive that. They waive the franchise and excise tax fee that Tennessee would otherwise charge. So having that CPA file, it is important because you got different properties in different states. We have to make sure all that stuff is done properly because every state wants their money.
Now, on that, you're saying like a place like Tennessee has that. Do they have to be on title, or can it just be, they're helping me, they gave me some money for the down payment, or how do they qualify for being the family business?
Yeah, if they are on title of the property or in the LLC that owns the property. So if you have, whether they're on title or not, I could have a trust hold title of the property, the LLC owned by myself, my sister, and my brother. Because we're related and we're part of a family, we would qualify for that exemption. So it's not necessarily who's on title; it's the LLC that owns the property and is going to be filing taxes will be exempt.
So there needs to be at least two people in that LLC to make it work.
Well, even if you own the property yourself, because you are a family, yep, you're a family-owned business, single member or multi-member. But if it was myself and my best friend, I don't qualify for that exemption. I'm going to pay the 6.5% tax.
So those are just the little nuances that most people would never know, and probably the average CPA probably wouldn't be aware. They'd have to potentially research that, or those are little things that add up over time if they're missed. So first one is not doing depreciation appropriately or not taking it. Second would be just in general not being aware of all these little nuances, filing in different states and having a competent CPA, right? So just mistakes in general, yeah.
Correct. My number 3 on the list is not properly calculating repairs and maintenance versus capitalized expenditures.
Can you define those a little bit more? Because that's one thing we always get questions about as well.
Yeah. So if I had a broken window and I needed to go repair that window and I paid $500, then that is an expense that I can write off 100% the year the expense incurred. If I have to go spend $20,000 putting a new roof on the property, different ballgame. Though I spent $20,000, well, divide that out because I can only write off a little bit. It's amortized over a 15-year period. So there's little things that you're doing. I got to, my trees all blew down in Florida. I got to get some new shrubbery put up, or the fence blew down, or whatever those may be. 15-year depreciation schedule. So the IRS has, if I have to buy new appliances, 5-year depreciation schedule. So everything that goes into the property has a different schedule that it depends on if it's a repair or maintenance. I can do 100% versus replacing all the windows. Now I have to amortize that. It's capitalized, meaning I have to divide it out over the course of time. So having a competent CPA is super important so that those are calculated properly.
Adam, is that the responsibility of the CPA, in your opinion, to tell people what is a capital expenditure and what is a repair list? I mean, this is typically how the conversation goes with, I would say, the average mom and pop investor, which is okay because we're all there at some point in time, and sometimes we're still there with our expense tracking, right? It's like, okay, let's scramble and get all the Excel documents and receipts back together. And I did this, and this repair on the property, and then just turn it in this chaotic format or Excel sheet to the CPA and okay, you deal with it and just file it appropriately. I mean, that's okay that people do that, but I mean, is a CPA really should they be taking that out and saying, okay, this is your capital expense, this is your repair, and how do you recommend that people keep track of this stuff?
Well, one of the things I love about working with your team at Rent to Retirement is you always have competent property managers, and they're the ones that are collecting the rent and making sure that the tenants are properties are kept up, and they will always give you usually a quarterly or annually what a list of your repairs and maintenance and things that are, which you can just turn right over to your CPA. So generally by January 31st, you'll be receiving all of the 1099s that are documenting that person collected money, they paid it to you. That all has to be documented and given to the IRS. So with that in mind, we make sure that those list of repairs and maintenance are something you're going to turn over to your CPA. And generally, your property manager is going to give that to you. For those people brave enough to manage their own property, they need to make sure that they are working with their CPA. Say, okay, when taxes roll around, what's the easiest way? How do you want me to give you this information? And yes, I believe it is the CPA's job and responsibility to make sure that these things are being calculated properly, because in the event of an audit, we want to make sure that everything is perfect. And as long as we're doing it the right way, we can sleep easy at night knowing that we've got it all done right. It might be a very light audit at that point, where they say, yep, you got your receipts. Yep, everything looks to be in order, and move on to the next guy.
What's your recommendation for if I've been doing my taxes on my own for, 3-4 years and I've still got some stuff, being depreciated? What's the best way to hand that off to a CPA who can actually, do it right? Is it just kind of, you send them a note that says, I replaced the roof 5 years ago, or kind of what's the good handoff there?
Yeah, so every single client that we onboard at NCH, we always get the last 2 years returns, so we can see exactly what you've been doing and how you've been doing it. It'll show on the Schedule E, or if it's a partnership, it'll show on your partnership return exactly how the cost basis of your property, any repairs and maintenance, the amortization schedules, all of those things are showing up on your tax return. So any competent CPA can see that exactly what you've been doing and what we should be doing in the future.
Okay. When you, so number 3 would be not doing appropriate expensing on the property. And I think probably everyone's guilty of that to some degree, because we just don't know, like, okay, what is an actual expense? Can we just run through a bullet point list of like, okay, owning a physical asset for the average investor, what are some things that you do expense? Let me know if I'm missing anything here. So we have obviously the expenses that we do to the property, right? Or we have things that we need to repair, which your manager will track. You have capital improvements, which they should also track, but just needs to be separated out due to the depreciation schedule. Also, you have your property management expenses, right? That should be a deduction or an expense. You also have your mortgage interest. What about taxes, insurance, closing costs with the property that you accrue? What about, setting up the LLC structure, and being able to, I think we already covered your CPA is actually an expense now that you're running a business. Are all those things expenses? And did I miss anything?
Those are all expenses, and I don't think you missed anything. I think you hit the nail on the head. All of those things are added up and they're all treated differently. So when you're buying that property, you're going to get a HUD-1 showing what was the land worth, what is the home worth. That's where your CPA can now start the 27.5-year depreciation schedule. So all of those things you're getting either from your title company when you buy the property, or from your property manager with the repairs and maintenance. The things that you've got to keep track of, and remember the kind of the rule, we always want to look at setting up LLCs just to make sure you and your family are protected. But with that, we try not to commingle funds. I don't want to use my personal credit cards to pay for these business expenses. There is a simple way to do it, and that is just keep a simple monthly expense report. If there is a water heater that broke and you got to buy a new one, it's okay that you got your credit card out and paid for it. Keep that receipt. It goes to your CPA. If the LLC paid for it, great. If you paid for it, that's fine too. We just need to keep receipts and have just a simple monthly expense report that we can share that information with our CPA. Our head CPA, he doesn't care how you get him information. If you've got it written on a napkin, he'll take it. he just wants to make sure he gets all the details and nothing gets left out. If you own I talked to a person that lives in Georgia, they're buying a property in Alabama, and they're going to drive over and take a look at the property. So that mileage, he gets 58.5 cents per mile. He's going to spend the night. He's got the hotel cost, the meals while he's there. All of those things you need to track and give to your CPA, because we can write all those things off. So in addition to the ordinary things that we come with the property, the repairs, maintenance, various expenditures, we also have the travel time. If we're going to check out that property, we bought a new build in Florida, we want to fly down there. Keep the airfare, the hotel, keep all of your receipts for that, because your CPA can write those things off.
Now, what about some of our people here? They're buying in places that they like to go, like for example, some of our Florida stuff, and they take the family down there. They don't turn it into a vacation, but they take the family down there, drive around a little bit. They see their property, but they do some other stuff. Do you get to write off everything? Like even like you take your kids out to dinner, or do you have to itemize it, or what do you have to do there?
Yeah, so you and your spouse, we can write that off for those expenses. If you're bringing your kids along for the trip, their airfare, assuming they stay in the same hotel room, perfect. If we're paying for separate airfare, I can't write my kids' airfare off. It'll be myself and my spouse. We can write off our expenses as the owner of the property. So that's a good question.
Yeah, and I think one thing that was recommended to me is just keeping detailed notes and maybe some minutes or whatever. You just keep notes of what you did, right? So if you're going down, say you want to go visit Disney, and also make a pit stop to check out your property, take some photos of it, marketing material, whatever. You can get really creative with this, right? If you're employing your kids and you're showcasing for you with a sign, whatever the case is, but just document it. And then turn over to your CPA and have them give you some guidance. These are one of these areas that we could have just ongoing discussions round and round and around. What counts, what doesn't. The main thing is you're being very detail oriented. I love that you brought up, Adam, keeping the expenses separate, because I think it gets overly convoluted and too confusing if you use personal credit cards and stuff. Like open up an LLC to hold your property so you have liability protection. But it just helps to have everything be so separate, right? The accounting, that's just a foolproof way to do it. Not only from a liability, but also from a tax perspective, in my opinion, is open up the LLC, have a separate bank account that now you use that EIN number from the LLC to set up that bank account, and just everything flows through that bank account. Have a new credit card in the LLC. Yes, it takes a little bit of work, and I know that you said they could do it with their personal, which is okay to start, but run this like a business, people, because you really need to be operating it as a business, especially if you plan to scale over time. And that's why it's important to have real estate professionals and CPAs that understand business and real estate. So, all right, number one is depreciation. Number two is going to have a competent CPA that knows all the different states. Three is not expensing things appropriately is the third most common mistake. What's number four?
Number four, Airbnbs. So that is a hot topic where people can make a lot of money with Airbnb properties. However, most people fail to realize that if you are managing your own property, and the IRS rules are if it's 7 days as an average rental or less, that is treated as a hotel or a business, and you are going to owe Social Security and Medicare tax on the rent you've been collecting from Airbnb. So that if we're hiring a property manager, they're doing everything. It is passive income. We're in good shape. But if you're managing it yourself, we got to make sure that you're aware of what these expenses are going to be, because usually the first year you've got the cost of furnishing the place. So on top of the purchase, you've also got the beds and the furniture and all these things. All of that stuff needs to be given to your CPA, and your CPA is always going to look at the totality of your tax situation before determining how much they're going to write off this year and how much they're going to push to future years, depending on what these expenses are. So, but the number four is people not realizing that Airbnb is a business. And if you have an average of 7-day rentals or less, it is going to be subject to Social Security and Medicare tax. And that's 15.3%. That could put you in a huge pinch if you're not doing it properly.
That's huge. I would say the average short-term rental is less than a week. So unless, of course, if you have a property manager running the property for you, then it would be passive, like you said. But if you're actively short-term renting the place out for a week on average, less than a week, then yeah, I mean, that's huge. I would say most people aren't aware of that. Also, on the flip side of that, potentially, that means you could do some accelerated depreciation, I believe, with that. So I mean, there's just so many nuances you got to be aware of. And of course, your expenses. I mean, this is a beautiful thing about real estate, though, especially on the passive side. It's like we call it tax-free income because you should be. I mean, on a single-family house, maybe you have $4,000 or $5,000 of annual cash flow, but in most cases, with all these expenses that we talked about, you probably should be reporting a loss, not only for this year, but that will carry into next year, in future years, and pass forward. And so that's. I mean, if you really think about that $5,000 that is kind of not taxed because of all the expenses and depreciation and things like this. I mean, that's probably the equivalent of like what, $8,000 or higher of actual like earned income. That's huge. If you had a rental portfolio that's paying you $100,000 annually and you're not having to pay taxes on any of that because of all of the write-offs, what is that equivalent to? 170? I mean, it's probably in the future it'll be 200,000 of earned income. That's huge, right? I mean, that's just a huge strategy of owning rental real estate. So Adam needs to get me off my soapbox here. But
yeah, I mean, I didn't get down to zero on my rentals. I think I had to pay $37 in taxes on all my rental income this year. So I didn't quite make it.
Did you expense everything, Adam? I don't know.
You'd have to ask NCH. I don't know.
Yeah. What's number 5, Adam?
Number 5. So this hot topic of cost segregation that everyone hears about, cost segregation, where we can accelerate depreciation and break up the property into different sections and write things off quicker. And you have to realize if that's something that you're going to be doing, it makes zero sense unless you're a real estate professional. And that's a completely different topic of conversation. But if you or your spouse qualify as a real estate professional, I talked to a guy on Sunday. He has 6 rental properties, 2 in Texas and 4 in Florida. And he is managing the 2 in Texas. His wife is a real estate agent. He's managing those 2 properties in Texas. The 4 in Florida, he has your property managers. So in his situation, he is going to be able to get some serious advantages as a real estate professional for the properties he is managing. The other properties, he isn't going to get any real estate professional designation for those. And so if he's trying to do cost segregation studies, the 4 that he's not managing aren't going to help him a bit. It's the property that he's managing. He could talk to his CPA about doing the cost segregation studies and accelerated depreciation for ones that he manages. So there's just a lot of misconceptions in how exactly that's going to help you. And if you're not a real estate professional, the words cost segregation should be forgotten, because it's not going to help you. It's going to cost you money and end up with no good for you.
This is one of these hot topics that we just talk about a lot. And I think a lot of the tax strategists out there are quick to jump into encouraging people to look at this because it is super sexy, right? It's like, oh, did you know that you can potentially take 30% discount on the property in year 1? And that's against active income, right? But what they maybe don't spend enough time on is like, all right, to really protect that in the eyes of the IRS, you need to qualify as a real estate professional. And here's the multiple criteria that you have to meet. And it is a lot. It's not only time, it's percentage of like where your income is coming from. It's the time associated with actual material participation in the properties themselves. I mean, at some point as you grow a larger portfolio, I mean, it's okay to have management, I think. And I'm not a CPA or attorney, but I have great ones. So but I think as you grow your portfolio at some degree, like you could take advantage of those things, even having property management, because you have a legitimate large business. But yeah, the question mark is like in these first few properties, because that's something that really is self-proclaimed. It's not like you have to apply for it. It's just you file your taxes that way. And if you need to be able to defend it when the IRS, if you were to be able to, or if you're going to be audited, which may be a hot topic with all the new IRS agents. So definitely a valid point. And again, that just goes back to having the right professionals guiding you and also filing your taxes, right? And I think it's very important that everyone understands that.
When it comes to the depreciation, if you are a real estate professional, or if you are doing short-term rentals yourself and doing that, I assume that whenever you go to sell the property, they're going to recapture your accelerated depreciation. They're not just going to say, well, we divided it by 27 and a half, right?
Correct. Yeah, so it's the near term gain, but it will be a pain later because you are accelerating the depreciation, taking it now versus taking it later. So that it will always catch up.
And possibly though, you could 1031 out of it into more assets, right? If that was your planned exit strategy. So that's one potential option, right?
That's always an option. And that's and we could continue on with the mistakes that people make, like with the 1031s, thinking that you can 1031 after the property sells. If you think you're going to 1031, you better contact the 1031 exchange intermediary now before you put the house up for sale or immediately thereafter, and make sure you got all those things lined up, because you can't sell the house and then come back and say, oh, I'm going to exchange it for another one. It doesn't work that way. So you need to work with those professionals right away if that's something that you're planning on. But yeah, another great strategy to minimize the depreciation recapture and the capital gains tax when you're selling properties.
And then we probably need to have you back on, Adam, to do one more deep dive into like estate planning. And we also talk about business credit. So those are two other things. Like, you guys are our go-to for LLC structuring and who we personally use, just because of how you do things, and just the team and support that you have, and basically having everything under one roof with both the tax and the LLC side. So we talk a lot about the LLCs, but many people may be unaware that NCH actually offers tax advising and tax filing. Like, all the time we get asked about, can you just recommend a CPA to file my taxes? Well, yes, we can, but just make sure that you're working with the right one, right? I mean, I think the point we're really hitting home today is you really need to stop filing your own taxes, and you really need to have a CPA that is familiar with real estate. We are recommending a team that we personally use and have for many years, right? Which you guys we've had thousands of clients that have had great success working with you guys. And so we appreciate that. You offer affordable rates for our clients and have exclusive things for them, which is awesome. So they can go to rentretirement.com/CPA if you want to ask about the tax specific. But most people are unfamiliar that you also go through estate planning, business credit. We'll do another show on that because that's something we haven't really talked about extensively. But can you just touch on that briefly? Like, what is estate planning and what's building business credit?
Yeah, so the estate planning, briefly, is that we're all going to die at some point. And if you have nothing in place, or if you only have a will, everything you own will go through probate. It is very expensive and usually takes a minimum of 2 years. Your family's going to have to hire probate attorneys in each state that you own property in to try and change ownership from you to your heirs. So we always recommend have a good revocable living trust established. It eliminates probate. And if the estate plan is done properly, if you forgot to put something in, it's not going through probate either. We do pour over wills. So that's the basis of it. It also provides financial privacy while you're alive. Most attorneys would recommend you call this, you and your wife's name, revocable living trust. There is no law that says we have to have your name in the name of the trust. And since generally we're going to put your primary residence into that family trust, we want to make sure that it's not your name. So if you've ever gone through a farm list of properties and you'll see, for example, the 123 Main Street Trust, and they don't call it their name, they do that strategically for a reason. So we have a whole department that all they do is make sure that trust, land trust, all of those things are put together properly for you and your family. And from a credit standpoint, understanding that your company is a brand new baby. It has no good credit. It has no bad credit. We certainly can build the credit, and it's nothing like personal credit. So building a business credit, it does take some time. Dun & Bradstreet is the #1 business credit reporting agency, and there are, we've been doing this for so long, there are systems in place where we can very quickly, within 3 to 6 months, build up a really good score for your business, so you're not having to use your personal credit for all of your business needs. So I have a whole department that focuses on that all day, every day. You talked about keeping your business expenses separate. If you can't get a business card, put any of your business expenses on that business card. Don't use your personal cards for that. It's also wise from an accounting standpoint. So it takes time to build these things up. We just have an accelerated system where we can very quickly build up a really good score for your company and use that for your gap funding, really to cover everything that hard money, private money, or money from banks don't cover. Use the business credit for.
Yeah, business credit is huge. I mean, a lot of people aren't even familiar with like what is business credit and why is that important? When is it used? What does that look like? What are the terms like? And it takes time, I mean, to build up, right? But business credit, I mean, you can have lines of credit, you can have access to capital, or loan structures that you may not otherwise. That's really important because having to go the hard money route is rather expensive. So, but everyone starts somewhere, and it's just putting those things in place. And I mean, not all of us are going to live forever like our Adam. So, having the estate planning is just one of those things that's important. Not super exciting to talk about, but important in the grand scheme of things. So,
good. Adam, when it comes to, I want to go back to one last thing. My last thing I want to touch on is you mentioned earlier before we got into the 5 things that you can go back over about 3 years of tax returns and change things. What things about those 3 years can be changed and what can't be changed?
Yeah, so your CPA can file an amendment, and we can, if you've forgotten to put things on the return, things that you had as expenses that you forgot or you had miscategorized, those things can be changed. But if you're running a business, for example, and you're supposed, like we talked about Airbnb, it is subject to Social Security and Medicare tax. Those things, if we do it properly, there's a strategy we use where we run your Airbnb income through an LLC taxed as an S corporation to significantly reduce what you owe in Social Security and Medicare tax. That has to be done. The payroll, the salary you take from your company, it has to be done before December 31st. So once December 31st passes, I can't go back and recalculate my income as W-2. That has to be done before the end of the year. So these are things where right now is the best time for you to do tax planning. If that's something you need, now's the time to talk to the CPA. Thank goodness we got past the October 17th deadline. So the CPAs are now probably sleeping today and recuperating. Most CPAs are working till midnight on the last day for extensions, taxes to be due. But now that they've recuperated, now's the time you need to be getting with your CPA, work with our CPAs, and get some tax planning done to make sure you're doing it right. Because there are certain things like the salary, can't change it. But a lot of things we can refile the taxes and add things you may have missed. You might have calculated things improperly. Those things can be fixed.
I'm glad that you said that because we talked about the frightening aspect of having a short-term rental property that you're currently managing with less than 7 days of average rental being an active business. But it's like, okay, what other options do you have, and what do you do in that scenario? And filing the S corp selection is a perfect option to avoid some of those additional taxes. And frankly, I think a lot of businesses fall into that category. Same thing with our active business, LLC, S corp selection, right? Because that's, I think a lot of smaller businesses like that or individual properties could operate. If it's an active business, would benefit from that. One of the low-hanging fruit people should look at. But all those things, I mean, again, having the right CPA obviously allows you to sleep at night and not have to pay these hefty penalties later, but also, they pay for themselves, and it's just an essential thing when you're running a business and owning rental real estate. So if anyone is interested in talking with Adam and his team over at NCH about whether it's just having a CPA file your taxes for you, helping you do tax planning, forming an LLC, estate planning, or business credit, any of those things under one umbrella, you guys are a one-stop shop. They can go to renttoretirement.com/CPA, at least to start the CPA discussion. I know that you guys have exclusive discounts and opportunities for rent to retirement clients, so we appreciate that, of course, as well as taking care of everyone. So, Adam, this has been exceptionally educational, and I will let our Adam finish us off with any last-minute questions.
Yeah, I would say I am not the one you want to talk with about the CPA stuff. It's definitely the NCH Adam that you want to talk with. But if you want to get some properties to actually, offset some taxes and, get that tax-free income, you can head on over to renttoretirement.com. That's renttoretirement.com. You can see everything there. You can schedule a call with us to talk with it. You'll find, as Zach said, the link to sign up with NCH to talk at renttoretirement.com/CPA. And Adam, thank you so much for joining us today. We really appreciate it. And we'll talk to everybody else on the next episode.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.